The U.S. Federal Reserve is indicating that rate cuts are likely on the horizon. In a recent meeting, Chair Jerome Powell expressed his focus on reducing benchmark inflation rates in 2024. This announcement sparked a positive reaction in the financial markets, with global share prices rising and the yield on 10-year US Treasuries falling below 4% for the first time since August. Investors are now expecting 6 quarter-point rate reductions by the Fed in 2024, double the number previously anticipated by the central bank. However, Powell also mentioned the possibility of rate hikes if inflationary pressure reemerges. Will your investment be impacted? Powell's statement led to a significant upswing across various asset classes, marking the best Fed day in nearly 15 years. Interest rate cuts generally favor stock prices, especially for growth companies reliant on future earnings. Riskier assets like low-quality tech stocks and high-yield bonds are also expected to benefit. This move by the Fed suggests that investors can confidently invest in riskier assets, anticipating global benefits from U.S. rate cuts. What about the 60-40 portfolio? The traditional 60% stock and 40% bond portfolio has struggled recently, but might see a turnaround. Historically, this mix offers solid returns, balancing stock growth with bond stability. However, as the Fed raised rates, both stocks and bonds suffered, leading to a 17% drop in such portfolios in the past year, their worst performance since 2008. Some studies even suggest all stock portfolios might outperform those mixed with bonds. The expected Fed cuts could lift stock prices and lower bond yields. The outcome, though, largely depends on the context of these cuts. If they're in response to a recession, it could be challenging. But if they're due to normalizing inflation and the Fed manages a soft landing, it might be a good time to invest in bonds. What does this mean for your cash savings? The recent period has been excellent for cash returns. In the US, high-yield savings accounts have offered rates over 4%. In Australia, the top savings rate is around 5.7%. In New Zealand, one-year term deposits have crossed 6%. However, future rate cuts may lower these high returns. Banks often adjust their yields to match benchmark interest rates, yet competition among banks for deposits might slow down any rate reductions. Exchange rates vary by currency. For the US dollar, the outlook isn't great. On Wednesday, every major currency strengthened against the dollar. This trend continued into Thursday in Asia. Japan's currency hit its strongest level since August. South Korea and Malaysia's currencies also gained over 1% against the dollar, indicating strength in emerging market currencies. What happens to mortgage and credit card rates? Homebuyers could see benefits in 2024. Mortgage rates typically fall when the Fed cuts rates. This could ease the global housing affordability crisis. In the U.S., mortgage rates have dropped for 4 consecutive weeks. The rate for a 30-year fixed mortgage is now 7.07%, the lowest since July. Credit card costs are also likely to decrease. Card issuers often base their interest rates on the prime rate, which is influenced by the Fed. These reductions in rates could aid consumers struggling with debt. How do Fed decisions influence rates across the world? Fed decisions have a wide-ranging impact. Higher U.S. rates boost the appeal of dollar-denominated assets. This draws capital away from other markets. As a result, other currencies often weaken. Many countries have struggled to protect their currencies against a strong dollar. This struggle adds to inflation and complicates repaying dollar-denominated debt. A change in Fed policy could reverse this trend. Some central banks follow the Fed's lead. An example is Hong Kong, which has its currency pegged to the US dollar. However, not all global authorities align with the Fed's moves. Europe's central bank president recently emphasized the ongoing battle against inflation. Similarly, Bank of England's Andrew Bailey noted that there is more work to be done in controlling consumer prices. I hope this helps. If you have any other questions or if you have your own inputs, leave them in the comment section below. Also, please don't forget to subscribe and hit the notification button for more information and relevant videos. This has been Ivory Hecker for Noble Gold News.